Good morning from our global headquarters in New York City. I'm Matt Miller. Danny Berger is off today. Welcome to Bloomberg Brief. Let's set your agenda for the day. Tariff shock. U.S. equities wipe out more than $2.5 trillion. And treasuries extend their rally as yields drop below 4%. Oil falls to $65 a barrel here in New York as the global trade war ramps up. Markets boost bets on the Fed's rate cuts, now expecting 100 basis points of reductions by year end. We're going to hear from Jerome Powell today. All of that ahead of the latest jobs report. Coming out at 8:30, the survey is for 140,000. The whisper number is for 120. Take a look at where futures are trading right now near their session lows. On the S&P, down more than 0.7%. NASDAQ futures down 0.4%. The NASDAQ took a bigger hit than the S&P yesterday. And Russell 2000 futures right now down 1.5%. After that index has fallen more than 21% from its highs in November. Small caps officially in a bear market. Take a look at treasuries. You see investors continuing to pile in to U.S. debt. Even after we saw the biggest drop in the dollar at one point yesterday in more than 2 decades, investors are buying treasuries, and the 10-year yield now at 3.9531, off another 8 basis points this morning. We're also keeping an eye on commodities. You can see that oil is trading under $65 a barrel on the NYMEX, 64.39. Brent crude down to 67.62. And gold selling off as investors looking for liquidity, right now down to $3,087 a troy ounce. In terms of the big stories we're watching, Stellantis is falling after the car maker temporarily halted production at plants in Canada and Mexico. The 25% tariff on imported vehicles that are not compliant with the USMCA may be a problem there. The move will result in a temporary layoff of 900 U.S. employees. Intel also rising after a report that the company tentatively agreed to a joint venture with TSMC that would run Intel's manufacturing plants. This would be the biggest story of the day if it wasn't, the day after Liberation Day. This plan is seen as a step to address Intel's financial struggles, a story we've been following for years now. And Sangamo Therapeutics shares are soaring after granting Eli Lilly exclusive rights to use its generic medicines for diseases of the central nervous system. So there's one bright spot in a sea of red this morning. In just a few minutes, we're going to speak to Nandini Ramakrishnan of JPMorgan Asset Management. And then later this hour, Citi's Veronica Clark joins us to talk about the fallout from Trump's tariff regime. In fact, why don't we kick it off right now? Nandini Ramakrishnan joins us, EM Equities macro strategist at JPMorgan Asset Management. And Nandini, I'm wondering what your take is from what we heard out of the White House on Wednesday, and then the market turmoil yesterday and the biggest drop for the S&P in 5 years.
Yeah, so I think from a global perspective, the tariffs were a lot higher than most people expected. So that's the market reaction. And I think the first step is understanding that it's pricing in a bit of a growth risk, both globally and in the U.S. So the U.S. consumer, who's now going to have to pay higher prices, U.S. businesses who will also have to import at higher costs. This has meant a few things for us in global markets. Firstly, repricing Fed expectations for lower interest rates this year. Second, the dollar weakening. I think this is going to be really excellent for EM assets who have had to deal with a strong dollar for many quarters. And finally, the fact that in China, while the tariffs are actually very high in terms of relative to other countries and perhaps above our expectations, it finally means that Beijing may actually deliver stimulus. So while there is a lot of global turmoil in markets, as you say, I think there are some bright spots for us to think about assets outside the U.S. and really look into the silver linings for some of the EM economies that I cover closely.
Can I ask just quickly about the Fed? And I know you're focused on EM, but no matter what assets, I guess, you're covering in financial markets, Jerome Powell's view is important. If we see these tariffs resulting in inflation, which it certainly looks like is a great possibility, is the Fed really going to be able to cut rates that drastically?
You're absolutely right. I think any market specialist has to watch the Fed, so no problem on the question. For sure, I think they're going to have to really decide between how much of the tariff inflation is transitory, using one of their favorite words again, and how much of the economic slowdown is something they want to ease into. I do think, on balance, the hit to the consumer, 70% of America's GDP, is going to be sizable, and hence they will have to slightly be biased towards easing despite higher inflation from tariff prices.
Nandini, I'm looking at, here in the U.S., an S&P 500 that sells, I think, 41% of its goods overseas. You're focused on EM equities, and those are, manufacturers and services providers that probably predominantly get their revenue from overseas, right? Especially in the U.S. Isn't it important for those companies to avoid tariffs, as probably none of them have been able to? I mean, how can you be bullish EM equities when we're looking at such massive tariff bills?
Yeah, good question. I think what has happened is the fact that the tariff announcements are quite so at the high end of the spectrum actually means that there is going to be this balancing act of the U.S. administration and the Fed to make sure the U.S. economy doesn't slow down too much. So in a sense, if the tariffs had been a bit more moderate, I would have been a little more concerned about the dollar strengthening or the Fed not easing as much, whereas actually on market dynamics, EM benefits from those factors I mentioned. But to your point on selling into the U.S., I think for the first consideration is there's a huge comparative advantage. There's a reason why globalization over the past many decades has meant that EM economies have been able to sell low-cost productive products into the U.S. And because of that, the U.S. has really benefited. So I don't think that immediately the U.S. is going to be able to substitute that production at the same price point. So despite there being a higher tariff, I think somewhere along the production and consumption cycle, the price will be absorbed. And I do worry it's a little bit more on the U.S. consumer or U.S. businesses who have to pass that through. But for now, we even track our own basket of EM exporters, specifically China exporters. And because the news of tariffs has been so kind of constantly grinding over the past few quarters, those stocks have already priced in a lot of that worry. So in the past day, those stocks are only down 3.5%, this China exporter basket. And that's actually not that bad compared to, let's say, S&P 500 over the past 2 days.
Do you expect China to be able to negotiate away some of these tariffs, Nandini, or any of the other regions that you cover? It seems Trump has laid out some pretty easy ways. If they stop exporting the precursors to fentanyl, they could lop 20% off of the tariffs they face, or even if they allow the sale of ByteDance's U.S. holdings of TikTok, they could lower the percentage of tariffs that they face.
I think there certainly is scope for China to reduce those tariffs in the negotiation. The Chinese officials are certainly aware of the dominance of exports as part of their economy and the role they play in producing these goods globally. So there certainly can be scope there. I think where it has benefits to China in terms of expanding business or maintaining market share, that's an area and in sectors where they're really going to be able to negotiate a bit more. On the other hand, there are countries like India where we don't expect too much negotiation. There's a huge domestic economy that a lot of the companies there can focus on. There's less of a attention in trying to make sure they maintain themselves in global supply chains where they haven't necessarily been a big part of it. So I think it's going to be a mixed bag on who and how different countries in EM and rest of world negotiate with the U.S.
What's your best bet in EM? What's your best pick right now in emerging markets, Nandini? It's a pretty large coverage area.
Yeah, so I think there's a couple themes. One, I really like the domestic consumer that's not really related to any of this tariff stuff. So there's a lot of space for that in India, in Mexico. Mexico equities are doing really well. They're up versus the rest of the world. So you can find these themes across the board. I also think for longer term investors, the trade on shareholder returns. So we're seeing a lot of that in Japan, some companies in China giving more dividends, buying more shares. This is a really good theme we're playing. And basically, anything that can survive with this kind of global growth slowdown, so inward domestic-facing companies would be our best pick.
Great to spend some time with you. Thanks so much for joining us. Nandini Ramakrishnan there from JPMorgan. Now let's get to some other top stories trending on the terminal this morning. Bloomberg sources say Republicans are weighing a new tax bracket for those earning $1 million or more to offset costs of their tax cut bill. Deliberations include a new top rate that would be around 39 to 40%. BP Chairman Helge Lund plans to step down as the oil giant pivots away from the net zero strategy he championed. In a statement, the company didn't give a precise date for his departure, but said that he would step down in due course. Lund will remain on the board to ensure a smooth transition, most likely until 2026. And a South Korean court has removed President Yoon from office over his ill-fated martial law declaration. That unanimous ruling immediately stripped him of his powers and set in motion a presidential election to take place within the next 60 days. The court's decision marks a potential conclusion to one of the most turbulent political chapters in South Korea's recent history. Coming up, President Trump leaves the door open to phenomenal tariff deals, NINSS. The EU, Canada, and other nations respond. That's next. This is Bloomberg.
It depends. If somebody said that we're going to give you something that's so phenomenal, as long as they're giving us something that's good. For instance, with TikTok as an example, we have a situation with TikTok where China will probably say, we'll approve a deal, but will you do something on the tariff?
That was President Trump on the kind of deals he's looking to strike to walk back any of his country-specific tariff rates. Let's bring in Bloomberg's Brennan Murray, who leads our global trade coverage for the latest. And Brennan, I think it's so fascinating that the president, he clearly cares about tariffs a lot, but it seems like he cares about TikTok even more. Why is this social media site for like cat dancing videos so key to the president of the United States of America?
Yeah, because it sounds like he wants to do deals, and that is one way where he even just suggested that he's willing to do a deal if his Chinese counterparts are. Look, America's trading partners have a big choice to make in the days and weeks ahead. Are they going to try to negotiate with the Trump administration a way out of these tariffs that he's putting into effect? Or are they going to start looking to diversify their trading relationships with other countries? We've seen the Canadians say recently on Bloomberg Television that they're looking to Europe and Asia to strengthen those ties. We heard leaders in Europe say, maybe we should encourage our companies to rethink their investments in the United States. So there's a lot to be answered yet as to whether Trump's tariff onslaught is going to drive countries to the negotiating table or drive them into some other alliances beyond the U.S. We have a big meeting of European trade ministers next week. That'll be very interesting to watch to see if there's cohesion or whether there's some fracturing along the lines based on the pain that the European economy is going to feel from these tariffs.
I heard Doug Ford, the premier from Ontario, saying on Balance of Power that they may consider lowering tariffs as a gesture of goodwill and then hope that the U.S. would follow. But didn't Israel try that as well? And they still got slapped with retaliatory or reciprocal tariffs, I should say. What can other countries really come to the table with?
Yeah, I mean, it's the kind of thing is that there were a lot of mixed messages in the long list of tariffs that the administration released. So if you're sitting on the other side of the table from the Trump administration, you really don't know what they want that will get them to lower the tariffs that they're about to impose on you. So I think that's going to be part of the uncertainty that businesses have to deal with going forward. Is where are these tariff rates going to end up? Are they going to be rolled back? Are they going to be raised in some sort of tit-for-tat escalation? It just leads to, and I think you're seeing this reflected in markets yesterday and today, a whole lot of uncertainty about whether this is going to revitalize the American industrial base or hurt consumer confidence and business confidence and ultimately slow growth.
Brendan, thanks very much. Brendan Murray leads our global trade coverage out of London. Now, America's biggest trading partner is the EU. It is weighing the costs of Trump's tariff bazooka. French President Emmanuel Macron urged European firms to suspend U.S. investments until the trade war can be resolved.
What's important is that we pause future investments, or those announced in recent weeks, until we've clarified things with the United States. Otherwise, what message would we send if we have major European players investing billions of euros in the American economy at a time when they are hitting us? So we need collective solidarity.
For more, Bloomberg's European correspondent Oliver Crook joins us. He is live at the NATO Foreign Ministers Summit in Brussels. Oliver, what are the harshest retaliatory responses that you've heard suggested thus far?
Yeah, so what we've heard so far, I think the strongest words we've heard so far are from Emmanuel Macron there, as you were just referencing, basically encouraging European companies to pause all of their investments in the United States, saying that basically you're sending an exceedingly poor signal if you just sort of come to heel the moment that Donald Trump just, fires these sort of bazookas, as you said, these tariff bazookas over the EU. It's a time to pause. It's a time to recalibrate, a time to formulate a response. We also heard from the German economy minister yesterday, Robert Habeck, basically likening these tariffs that he's imposed across the world to something that is as severe as Russia's invasion of Ukraine in terms of the impact that it'll have on the global economy. Obviously, as you know, Matt, the German economy is singularly sort of exposed to the U.S. economy. A lot of that trade surplus that comes from the EU is really down to the German economy. But we've also been speaking to the Canadian foreign minister, and they retaliated overnight. Have a listen to what the Canadian foreign minister told me a little bit earlier today, and their approach has been basically maximum pressure.
I think the only strategy the U.S. is putting on the table right now is they want to have strong hands every time they're negotiating with countries, and they want to do bilateral deals. What is clear is the president wants to do a global reset on trade, and it's his vision to do so. I've had conversations with Secretary Rubio about that, and the question is how much political capital is President Trump willing to spend on a recession?
And Matt, it's fairly clear that the United States is banking on the fact that they're basically the only game in town and that everybody will fall in line. But what I'm hearing from foreign ministers, what I heard from the Canadian foreign ministers, is that this realignment of global trade that the United States is trying to orchestrate is going to have consequences elsewhere. And it means that the Canadians are looking to build stronger relationships with the EU, stronger relationships in Asia Pacific. So again, we'll see to what degree this sort of gamble by the Trump administration will pay off. But also the question is, how much economic pain are they willing to endure? This is going to be a waiting game, and it's going to hurt everybody.
The Canadians trade over $700 billion with the U.S. every year, but the EU collectively trades about $1 trillion with the U.S. every year. And as the outgoing chancellor has said in Germany, is the largest single market in the world. Can they act in unison? I mean, can the EU really agree to a serious retaliatory response?
Yeah, Matt, I think this is going to be at the center of discussions that we're going to begin next week in Luxembourg when you have the EU trade ministers assembling there to basically try to orchestrate a collective response. You'll remember earlier in the week, Ursula von der Leyen was sort of guarded in her language, saying that we're preparing measures, not really committing to the direction to go. But as you say, Matt, it's always difficult to find consensus within the EU on a number of different issues. And as we were just talking about, Germany is highly exposed to the United States on the question of trade. For many other European nations, this is not the primary issue. Many of them on the eastern flank, for example, really would like to continue to keep the U.S. on board, keep them on side for the question of defense and the question of Ukraine. And there is a question, I think, for European leaders to what degree all of these issues, foreign policy, economics, trade, and defense, basically all sort of bleed together in the mind of the Trump administration. And that is going to open some debate here within the European Union.
Oliver Crook reporting from Brussels. Thanks very much from that. Oliver is our European correspondent on the continent. Coming up against the clock with the TikTok deadline looming, potential details of a potential deal are starting to take shape. We'll tell you them next. This is Bloomberg. Time now for our front page news, a look at what's making headlines around the world. First up, on the New York Times, details of a potential TikTok deal are starting to take shape as Saturday's deadline looms. President Trump told reporters that his administration was very close to a deal and would consider using the app as a negotiating chip with China on tariffs. Next up, the Washington Post reports that General Timothy Hoff was fired from his position leading the National Security Agency. Far-right activist Laura Loomer confirms she advocated for the dismissal during a meeting with the president. And on the BBC, Eli Lilly CEO David Ricks described President Trump's tariffs as a watershed moment in U.S. economic history. He said tariffs are, quote, hard to come back from. Ricks was also doubtful it would create hundreds of billions in additional revenue for the U.S. as promised by the president. Coming up, we'll count down to the payrolls report with Citi's Veronica Clark next. This is Bloomberg. From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Matt Miller. Let's set your agenda for the day. Tariff shock. U.S. equities wipe out $2.5 trillion. Treasuries extend a rally, and oil drops as the global trade war ramps up. Markets boost bets on the Fed's rate cuts, now expecting 100 basis points of reductions by year end in the face of inflation. All that and more ahead of the latest jobs report and remarks from Fed Chair Powell at 11:30 this morning. Take a look at what's going on with futures right now at their session lows. S&P futures off almost 1% now. NASDAQ futures down about 0.7%. Russell 2000 futures down more than 1.5%. And the small caps are in a technical bear market now after falling 22% from November high. In terms of Treasuries, here you can see the U.S. 10-year yield well under 4% at 3.9475, a drop of more than 8 basis points, and the curve steepener is on as well. In terms of commodities, we have oil at one point down below 65, in fact, still below $65 a barrel on the NYMEX, 64.59 for New York crude. Brent crude down to 67.84, and gold being sold off, possibly in search of liquidity, at $3,092 a troy ounce. We are 3 hours away from that March jobs report. Bloomberg's Valerie Teitel is with us for more. So, Valerie, lay out what we expect for non-farm payrolls.
Yeah, yet another catalyst for the market to contend with in just a few hours' time. 140K is the consensus estimate. This would be a drop down from the prior reading of 150K. So more labor market loosening in the cards. The unemployment rate is expected to stay steady at 4.1%. The risk is, Matt, is for a bad print. That would really be an acceleratory move to the downside when it comes to this risk-off move in the equity market. But some economists are out there arguing that it's too soon for this tariff shock to show up in a weak labor market print. We might have to wait for a few more months to get a weak print reading. But we will get Powell's take on the number. He is speaking just a few hours after this print. This comes as the market has really accelerated the amount of cuts that it expects from the Federal Reserve. We're now expecting 100 basis points of cuts. That's 4 cuts between now and year end. When he spoke only 2 weeks ago, it was around 2 cuts expected from the Federal Reserve. Well, the market will be very closely watching whether he echoes any of this economic pessimism. If in any way he opens the door to perhaps front-loading cuts instead of backloading them in a way to perhaps wait for more weakness in the hard data. Another thing, Matt, that I have to note is that this risk-off move that is continuing, it's very different today when it comes to FX. Yesterday saw one of the worst days for the Bloomberg Dollar Index in years, but we are seeing that rebounding so far this morning. That is a very stark contrast to what we saw yesterday.
All right. Valerie, thanks very much. Valerie Teitel coming to us from London with a setup for the jobs report. Let's talk about it with Veronica Clark. She is U.S. economist at Citi and joins us here on the desk at 7:31. Lex, thanks so much for coming in early, Veronica. What do you expect, first of all? I mean, the whisper number is for 120,000, and clearly this number isn't going to be affected by Wednesday's tariff announcement yet. So is it going to be clean and good?
Yeah, we do think we'll see more slowing. So we're even below that whisper number at 95,000. I think the most important number this morning is that unemployment rate, though. We do have that rising from 4.1% to 4.2%. But yeah, this won't really reflect the big government layoffs yet, the tariff announcement, of course, which does mean if it is a strong reading, it feels a little stale. If it's a weaker reading, well, then the labor market was already slowing before we get to those effects.
So you are concerned about growth. That slowing labor market plus the government layoffs, spending cuts. How do you expect growth to play out this year? Yeah,
we were already going into this year with an expectation for softer growth, slowing growth. We did see the unemployment rate rising last year. I think high rates are taking a long time to weigh on the economy, but that's part of the story. And then as we get into the spring and summer, really around May, I think we'll start to see all these effects piling on top of each other. The government layoffs, more weakness in hiring, tariff uncertainty, all of that.
We've had weakness in the soft data, consumer expectations for inflation starting to climb. And if you look at the gasoline chart, I pull it up all the time on the Bloomberg. I care about cars and motorcycles, and I have to put fuel in them. It's pretty shocking how much the price at the pump has risen year to date. How can the Fed cut rates if we're staring at inflation like this?
Yeah, I would take maybe gas prices with a bit of a grain of salt. This is the time of year when they usually increase. It's into the summer travel season. When they're seasonally adjusted, maybe they won't be as strong. But certainly inflation expectations will get concerning. For now, the Fed is still seeing long-run inflation expectations as anchored. Certainly in the University of Michigan survey, they've come up. We'll be watching the New York Fed inflation expectations in a couple weeks. That's maybe a better measure for Fed officials. But I think they're going into this tariff period, and we heard this from Chair Powell a couple weeks ago, expecting that tariff inflation will be transitory. They're expecting higher goods prices, but they're not expecting the broad-based spillover to things like services.
I mean, transitory or not, if you start charging me 10 or 20% more for a car, it's unaffordable.
Yeah, absolutely. But that is it is a different backdrop than I think the inflation of a couple years ago, because we had very tight labor markets in 2022. If you were expecting and experiencing higher prices, you could ask for a higher wage and you would be granted that higher wage.
Sure,
maybe.
Problem.
In tight labor markets, on a macro sense, that's what should happen. But this is a very different labor market. The unemployment rate rising, much softer labor demand already, hiring rates that have already been very low for 2 years. I wouldn't be as worried about that self-fulfilling nature of high inflation.
What do you think about treasuries? Right now, we're looking at a drop, price up, yield down, right, as investors pile in. But the dollar is, at one point yesterday, we saw the dollar drop the most that it has in 2 decades. So is demand going to persist for treasuries, or maybe foreign investors going to strike?
Yeah, I mean, certainly on the Fed expectation side, I do think there can be more demand for treasuries, at least pricing in more Fed cuts. Of course, we're now pricing a whole 100 basis points for this year. We're actually still expecting a bit more than that. We're at 125. But if this is a much weaker demand story for the U.S., the end of that U.S. exceptionalism narrative, maybe that's why the dollar is weaker, but of course that's a Fed that's cutting then too.
So basically, to underline it, you're not terribly concerned about inflation holding the Fed back from cuts. They can, in slowing growth, continue to bring rates down because you don't think we're going to see, 4 inflation or more?
I think we might, but I think it will be just a very mechanical kind of increase. I think we'll see it in certain goods prices, of course, anything that is directly impacted by tariffs, and those can be big. It was much bigger than we were expecting on Wednesday, would raise our inflation forecast because of that. But as long as you do see long-run inflation expectations more anchored, wages are slowing, maybe home prices slowing, services prices slowing, you're not as worried about that broad spillover like in 2022.
And you're not concerned about a recession then?
We are. We would be. We do have much softer growth already. We are expecting activity close to flat for a lot of the year, the unemployment rate rising to 5%, maybe more. And so, yeah, that's kind of borderline. You might be in this more recessionary
The
scenario.
Fed's 125 basis points of cuts don't pull us out of that nosedive?
That 125 basis points of cuts takes us to where the Fed thinks the neutral rate is. So maybe if you're trying to balance the downside risk to growth, the upside risk to inflation, that's maybe where you want to be. It obviously can help spur, housing demand, maybe some investment, things like that, but maybe not immediately.
Let me ask about jobs in this country, because 5% unemployment sounds pretty scary from these levels. The idea is that these tariffs will spur manufacturers to move factories from overseas, maybe Southeast Asia to like Michigan. How likely is that from an economist's point of view?
Yeah, so I think over many year period, you might see some of those effects. But I think right now, part of the issue is that these are very large tariffs. They've been it's uncertain what's coming next, if they're going to last very long. So you're not going to necessarily make those plans immediately. And it would, even if you were making those plans immediately, it would take many years probably for those types of dynamics to shift. And in the meantime, manufacturing is a very exposed sector to tariffs. We did see manufacturing contracting in 2018, 2019.
So you don't expect us to see a replacement of those. I think Trump always says 90,000 factories have been wiped out here in the U.S. What would you say we bring back, like 10,000?
I wouldn't know a number for that. We really don't think of economic activity in terms of factories, maybe industrial production and things like that. But I think the most immediate effect in the near term is going to be negative for manufacturing.
All right, Veronica, great to have you here with us this morning. Thanks so much for joining us. Citi's Veronica Clark talking to us about the economic effects of this new tariff regime. Now, two other top stories trending on the terminal this morning. A South Korean court has removed President Yoon from office over his ill-fated martial law declaration. The unanimous ruling immediately stripped him of his powers and set in motion a presidential election to take place within the next 60 days. The court's decision marks a potential conclusion to one of the most turbulent political chapters in South Korea's recent history. BP Chairman Helge Lund plans to step down as the struggling oil major pivots away from the net zero strategy he championed. In a statement, the company didn't give a precise date for his departure, saying only that he would step down in due course. Once a new chairperson has been chosen, Lund will remain on the board to ensure a smooth transition, possibly until 2026. And the Trump administration has outlined changes it wants from Harvard University in a letter days after threatening to end as much as $9 billion in federal funding for the school. The changes include eliminating DEI programs, a broad ban on masks, and merit-based admissions. The demands mark an escalation of a pressure campaign that has targeted several U.S. universities. Harvard confirmed receiving the letter, but didn't comment. Coming up, the price of oil continues to drop as the global outlook gets clouded by trade war. More on that next. This is Bloomberg.
It depends. If somebody said that we're going to give you something that's so phenomenal, as long as they're giving us something that's good. For instance, with TikTok as an example, we have a situation with TikTok where China will probably say, we'll approve a deal, but will you do something on the tariff?
That was President Trump on the kind of deals he's looking to strike to walk back any of his country-specific tariff rates, something as phenomenal as a TikTok deal. Let's bring in Bloomberg's global business editor, Josh Gallu, in Munich for the latest It strikes me as pretty obvious that if someone comes up with a phenomenal offer, he's going to walk back some of these tariffs, Josh. But is TikTok really that important?
Well, sometimes it's not entirely clear what's most important to Trump, right? Sometimes he's looking for a massive political victory, and that's something that's been signaled all along. But beyond that, you have to look at the structure of these tariffs, and there is a school of thought that the 10% blanket tariff is maybe there to stay, while all the others are up for negotiation. And as he said in the quote that you just played, he's looking for deals, and this is creating great uncertainty for companies that are having to decide how long these are going to be in place, at what rate actually it's going to be in place when they're thinking about long-term investment decisions, supply chains, and whether to put money into the U.S. to avoid it. So there's a lot up in the air still, even though these were announced with great formality yesterday. These are executive orders, not acts of legislation. They can be changed today if he wanted to by just signing a piece of paper.
Yeah, and of course, the so-called reciprocal tariffs don't go into effect until, I think, next Wednesday. Josh, what else beyond, a social media app can countries offer? I mean, I note that Israel did away with its tariffs on U.S. goods in hope that it would get, a softer response, and still was slapped with 17% tariffs.
Yeah, that's again, it's not entirely clear, and these things are going to have to take place bilaterally. They're already being flooded with requests, and different markets are understandably responding differently. So you have Europe and China, just as Canada did, taking a pretty firm approach, saying they're going to retaliate. But on the other hand, you have places like Vietnam, Cambodia, much smaller markets they really don't have a lot of negotiating power. So what they will have to do to get some relief here isn't entirely clear, but they're pursuing it very aggressively. The EU is, of course, in a different position. They're going to play hardball, and they're talking about anything from taxes on digital services to even using their anti-coercion law, which would allow them to start cutting off trade, cutting off services, and even public procurement, foreign direct investment, things like that would escalate things very quickly.
You are sitting in Munich, the heart of BMW. Of course, they also produce a lot of vehicles here in the U.S. But the companies that you talk to, and you're a global business editor for Bloomberg News, how many of them are planning on relocating more manufacturing to the U.S. in response to this?
Well, the companies have been talking about this for a while in the run-up to this tariff announcement. It's been well telegraphed. So many have already announced massive investments in ports, in factories in the U.S., and a plan to move some manufacturing there to avoid this. But the reality is that this doesn't happen overnight. And you already have Macron in France urging companies not to invest in the U.S., not to put any more money into their businesses there, which doesn't seem very realistic, but still it shows the political sentiment here. The extent to which companies are prepared to move operations there is really up in the air, and again, it gets to the uncertainty of the tariffs, how long they're going to be in place, at what rate they're really going to be in place, and what kinds of deals various countries are able to strike. Again, this can change very quickly, and not only that, but the supply chains are, for a company like BMW or another automaker, the supply chains are extremely complex. So it's not as simple as just picking up operations and moving them into the U.S.
All right, Josh, thanks so much for joining us. Josh Gallo, global business editor for Bloomberg News out of Munich. Get yourself over the Augustiner Keller and award yourself with a beer on this Friday. Oil prices continue to fall as President Trump's tariffs spur demand fears, and with OPEC Plus making a shock decision to increase output faster than previously announced. For more, we're joined by Bloomberg's Will Kennedy, who runs our global oil coverage, energy coverage. Will, I thought this was a particularly surprising announcement, and I guess very good news for President Trump and economies around the globe, because we're looking at prices just drop.
Yep, it will be felt at the pump. People will be spending less to fill up their cars. How good news it is, I'm not sure, because part of the plunge reflects deteriorating expectations about the global economy and demand for fuel and energy globally. But clearly it was an interesting day for OPEC to choose. Oil was already trading down sort of 4 or 5% when they made this surprise announcement that they were going to increase production 3 times faster than they'd previously planned. And now we've got prices down 10% over 2 days, and the lowest in 3 years in the London market.
So why are they boosting production? Do they need the cash? I mean, are these economies just as strained as others around the world?
I think there are a few things going on. The immediate catalyst was the fact that Saudi Arabia, that leads the OPEC Plus group, has grown increasingly frustrated by the overproduction from some members of OPEC Plus, principally Kazakhstan and Iraq. And I think that one of the justifications that we heard talking to people yesterday was that the Saudis feel that they need to teach those people who aren't sticking to the agreement the costs of their overproduction. So it was a sort of warning to that group. But in the background, you have 2 other things that I'd point out. One, because other people aren't sticking to the production, Saudi Arabia is having to grapple with lower oil prices without increasing its market share. So by going faster, they can counteract the impact of lower oil prices by pumping more barrels. And in the background, as with most stories we talk about these days, Matt, in the background is Donald Trump, who has made clear, both in his first presidency and already in this presidency, that low oil prices are a priority, and that he would like Saudi Arabia and OPEC to play their part in ensuring that oil prices are kept in check.
All right, Will, really appreciate your time on this Friday. Will Kennedy is Bloomberg's senior executive editor for energy and commodities. Thanks very much. Coming up, jobs. The jobs report today, crucial for this market. And then we get remarks from Fed Chair Jerome Powell, front and center in your day ahead. Among the many important guests we talked to on the program today, Kevin Hassett joins us later on in the day, and Howard Marks joins us as well on Open Interest. This is Bloomberg. This is Bloomberg Brief. I'm Matt Miller here in New York City. We are seeing the Euro Stoxx 50 index, a collection of the biggest stocks in Europe, drop to correction territory. It is now off 10% from its high. However, the Stoxx 50 is still up 1.7% year to date. And if you're an American investor, in dollar terms, it's up 8%. So better than we're looking at in America. The jobs report coming out, speaking of America, at 8:30 a.m. Eastern time. It's the main event. We're going to hear from Fed Chair Jerome Powell at 11:25. That will also be crucial for these markets. And then we get more Fed speak throughout the day. Michael Barr at noon, Governor Chris Waller at 12:45. In terms of the stocks to watch, Exxon and other energy stocks are extending losses as OPEC boosts production and we see the price of oil fall. Apple is also lower after losing more than $313 billion in market cap in one session yesterday. And then Intel gaining after a report the firm has tentatively agreed to a joint venture with TSMC to run Intel's manufacturing plants. That's all from me here in New York. Surveillance is up next. This is Bloomberg.